Good afternoon, ladies and gentlemen. In fact, good evening. It's past 3 o'clock. Thank you very much for joining us. I think we've seen an exceptional amount of interest within our members on the subject audit risk and internal controls. Of course, a topic which is very important, very close to the hearts of accountants. Um, Today's discussion, I think, is as much as it is important, also needs a lot of interaction, a lot of questioning, a lot of questioning the concepts. We don't want it to be a theoretical discussion only, and therefore the questions that you're going to ask is going to drive the conversation also. So keep your questions, comments practical. Today, the trainer that we have with us is none other than Mr. Rizwan Safdar. He's an ACCA member and currently working in the capacity of financial expert for the Economic Reforms Unit. Rizwan has about 13 years of national and international experience in financial accounting and reporting, analysis and budgeting, and more importantly, internal control and SOX, risk management, governance reforms, business advisory services. So quite a diversified experience skill set that our trainer has. Um, Rizwan has been associated, if you look at the organizations, the kind of organizations he has worked for, he's been associated with Jazz, Motorola, Nokia, Siemens, so mainly the telecom sector, and Ernst & Young in multiple local and regional roles. So I think very well suited for the discussion.
Afrasia?
You will get a link to the recording and the handouts at the same time. Okay, so I think with that, we will hand over to Rizwan, who will take us through the rest of the session. And Rizwan, over to you.
Thank you, Harun. I just get connected again. I welcome you all on behalf of ACCA and just looking forward to have a very fruitful discussion over audit risk and internal controls. Harun gave a very well-defined shared the profile of me about my experience and my associations with different enterprises. Just to give you an overview about the today's session that we're going to have, there are two segments that we're going to cover. The audit risk, the first one. During initial 90 minutes, we will cover the audit risk, and in the later part of the session, we will cover the internal controls. Initially, we will have a look over the what is audit risk, what are the components of audit risk, what is the combined risk assessment in an audit, and what are the factors that affect the audit risk, and how the auditors can apply certain techniques and mechanics to reduce the overall audit risk for an audit engagement. Then we will move forward to have a look at what are internal controls and what is internal control framework, how many types of controls are there and what are the characteristics. And then we will see that what an effective internal control system and environment really means for an entity. Just getting started with the discussion. Just to give a brief about the audit risk, it is also known as residual risk. And this is the risk that an auditor may issue an unqualified report due to the failure to detect material misstatements either due to an error or a fraud. In other words, it refers to the probability of the statements not giving a true and fair view after the audit is completed. It means that there were certain, because during an audit assignment, uh, we do not give an absolute assurance about the financial statements. We give a reasonable assurance based on a sampling and the techniques that we apply to perform our test of details and analytical procedures. So it means that there were certain elements that we overlooked and we were not able to detect misstatements, error, or any frauds into the financial statements. This sums up the definition for an audit risk. There are three components for an audit risk: the inherent risk, the control risk, and the detection risk. Uh, just have a look at it. What are these components really means? The inherent risk that is involved related to the nature of the business or the entity or the transactions. Like what are the risks associated with the entity itself, its ecosystem, and the transactions that are they performing on a day-to-day basis. The second component of the audit risk is control risk. It means that the internal control system that is being implemented by the management of the enterprise is unable to detect, prevent any material misstatement, which is during the routine operations of the entity. So if any of the misstatement is not being prevented or detected by the controls being established by an entity, it refers to the control risk. And the last part of the component of audit risk is detection risk. Detection risk means that the procedures that are defined by the auditor in an audit engagement, they fail to detect existence of a material misstatement or fraud in the financial statements. So these are the three interrelated components of the audit risk. Now, just have a look at these components one by one in a bit of details. So these are the three components of audit risk. Uh, the inherent risk, the first one is that understand the entity and its environment. This risk derives its value from the ecosystem and the entity itself. And for example, that an entity that have a more complex and a decentralized processing system is more inclined to higher inherent risk. Like for example, a telco-based entity or a digital services provider do have a different products and are working on a remote locations, they have a little higher chances of inherent risk in their transactions and operation as compared to an entity that is working in a centralized and a compact environment. There are two major as I discussed, there are two components. I lost the transaction screen. जी स्क्रीन बंद हो गई है कनेक्शन we have been disconnected.
What is disconnected? Sorry, sir.
किसी को भिजवाएं इधर ये क्लोज हो गया है आपका सिस्टम.
Rizwan, we can hear you and we can see the screen as well. आले हमाद को कॉल करने का वहां पर जाए. I'm sending Ale Hamad to you, but we can see the screen. You are on slide inherent risk.
स्क्रीन का नहीं है स्क्रीन Apologies for the delay. Actually, the inherent risk covers the two segments. So the first segment is the entity information, and the second one is the consideration about transactions that they are engaged in. So if you have to look at the inherent risk, the auditor needs to be have a very sound understanding of the nature of client business, the product and services they are engaged, their business model, the information technology environment, the management motivations, like are their bonuses are based on net income, any stock options are also there for short-term achieving targets, and the last but not the least, the integrity of the management. Uh, Initial few bullets are very clear, but if we talk about the integrity of the management, it means that auditor needs to be vigilant about the compliance reports issued by the management, the HR code of conduct reports, any forensic reports that are issued by the management about their high-level management within the entity. If you look at the transaction-specific considerations, auditors need to be vigilant about the non-routine transactions. Like there are transactions, like for example, merger and acquisitions. There are transactions about entering into a new service area, a new product. The second one is the judgment, subjective estimates involved in accounting issues. For example, amortization, decision about changing life of the useful assets. And then the next one is the volume and complexity of the transactions and any new accounting pronouncements, like there are new introduction of new IFRS or international accounting standards, like IFRS 16 or 15 about revenue. So there are these are the areas that the auditor needs to be remain very vigilant. And then the large transactions with related party. In case the business have a lot of related parties and they are on a frequent basis dealing with them, so these transactions need to be accounted for while calculating and assessing the inherent risk. As we discussed, some of this consideration, there are certain sources of inherent risk that needs to be kept in mind, like the management themselves is responsible to design the systems and processes as well as policy and procedures. So there is a chance that these policy procedures, system and processes are not implemented in their true letter and spirit. So if they are not implemented, there is a chance that certain things will remain undetected and the errors and fault will go unprevented. So the second one is transactions that involve exchange of cash may have higher inherent risk than transactions involving settlement by checks. So due to the nature of itself, that any transaction that is being settled in cash has a higher inherent risk as compared to a transaction that is settled by any of the banking instrument, for example, checks or pay orders. Then, if the business have complex business transactions, for example, the derivative instruments are there, the valuation and measurement. Of course, there are certain assumptions and management decision involved with them. So any business that have a complex business transactions have a relatively higher inherent risk as compared to a business that do not have such complex transactions. The next one is about the nature of the business. If a business is engaged in a high-tech product, there can be some potential issues in valuation of inventory because on a daily basis, on a very frequent basis, there are technological improvements in the market. So the inventory that is valued by the management will not have its intrinsic value as per the changing business environment. The next one is the transaction requiring a high level of judgment, like I mentioned, amortization period. So if there is an intangible asset, any license, any right to use an asset, and there is a judgment involved about the period for which the cost of the asset needs to be amortized. Inherent risk for an industry that have frequent technological developments remains high as compared to the industry that is working in a more, you can say, stable sort of environment because there is less risk and exposure to technological obsolescence. And the last one is the company which has already misreported certain figures in past may be more likely to misreport it again. These things are the auditor needs to review the working papers from the prior years, that is there anything mentioned in the management letters, in the board letters, or any of the ML that been issued to the management by the auditor that have certain misreported figures in that. So these are certain sources of inherent risk. The auditors need to make a checklist and make a mark that these points need to be keep in consideration while audit planning. The next portion or the components of audit risk is the control risk. The control risk, as I mentioned earlier, is that the internal control processes implemented by the entities are not working properly in their true letter and spirit. It means that inadequacy or inefficiency of internal control systems that exist. The second one is that for small entities, this risk is relatively high because the internal control system either may not exist at all, or even if the systems are there, the management or the team is not following these systems. The next one is the internal control systems are designed and developed by the management, and it is their responsibility to implement a proper and effective system of internal controls within the entity. So this risk is not in control of the auditor. Auditors just need to assess the risk of internal controls and the inherent risk, because these two risks are not part of auditor work scope. They just need to assess it up and then draft their procedures. Control risk also said to be higher if the systems and their functioning is not up to the mark. Like for example, the management have implemented a system to process transactions or to do some reconciliation, but the system is not performing the system reconciliation properly, and there are some exception lines in them. So in such a case, the inherent risk, control risk, will definitely be a little higher. It is generally advisable for the auditor to presume at the planning stage the control risk is high. That is because at the start of an audit, or even it's a new engagement, the auditor is not aware of the efficiency and effectiveness of internal control processes. What does it mean for an entity perspective? An effective internal control environment strengthens the entity reputation as a trusted and ethical business. So of course, an entity that operates in an effective internal control environment has a lot more business value than one who doesn't have an internal control environment, or either it's ineffective. So why internal control systems needs to be evaluated at a planning stage by the auditor? The first one is that it is very crucial for an auditor to have an understanding of internal control system and processes, because it's very crucial to the audit process. For example, if the internal controls are not implemented properly, the control risk is going to be very high. And a higher control risk means the audit risk will definitely be high. So, test of details, we will look at it in a later part of the session, that needs to be modified, or specific audit procedures need to be developed. It also helps the evaluation of internal control system to test check that are need to be carried out during the course of the audit. Also, the maturity levels for the substantive procedures, i.e. test of details and analytical procedures, are based on the level of this. It also enables the auditors to determine the size of the sample. And the last but not the least, it helps auditor to determine the nature, timing, and extent of the audit procedures to be carried out. The next one is the detection risk. The detection risk, this is on part of the auditor, that failure to determine a misstatement in the financial statement is reported as a detection risk, that the processes or the test plan that they have implemented will not be able to pick up or notify a material misstatement in either the class of transactions or account balances. It means that non-detection of errors or misstatement in financial statement, thereby giving an incorrect opinion about the financial statements of the firm. So what are the sources of detection risk? The poor audit planning, like the audit plan was not prepared well, keeping view the business lines and the cost of transactions. Selection of wrong audit procedures on part of the auditor, like for example, the auditor is applying the audit procedures that was required for the textile industry to a telecom sector entity, or if the audit procedures are for the banking sector, they're applying for a IT-based service company. Also, the poor interaction between the audit management and the auditor is also one of the source of the lack of detection risk. The poor understanding of client business and complexity of financial statements, of course, it contributes to a high detection risk and wrong selection of sample size. Auditor needs to be very vigilant and very, you can say, enlightened about the transactions that they are going to test and the sample size they are going to use to test the certain account balances. There are some specific consideration for all this risk for an audit risk perspective. That is inclusion of additional procedures to reduce audit risk to an acceptable level. The overall risk, like the once auditors calculated the inherent risk, the control risk, and the detection risk, it means that these all three components should be balanced at an optimal level to make sure the audit risk is within acceptable limits for the engagement. What it means that if the level of control and inherent risk is high, the auditor can increase the sample size for audit testing, thereby reducing the detection risk. And vice versa, if the control and detection risk is considered to be low, the auditor can reduce the sample size for testing purposes and increase the detection risk. So these are the two considerations that the first one, the audit risk needs to be within the acceptable limit for the auditor. And the second thing is that the control and inherent risk levels determine the size of the audit sample for testing purposes. Once I have looked through the three components of audit risk, now let us see how these three components are interrelated and how these three components adds to the sample size selection and the test of details or the substantive procedures to be performed. During engagement, the auditor should address audit risk at two levels. The first level is the auditor should be assessing the risk at the financial statement level and also at the relevant assertion level. But what does it mean for an auditor to assess the risk at a financial statement level? It means who are the intended users of the financial statement. Like, if we are performing an audit and a company is a public listed company, the users of the financial statements are all the shareholders, the board of directors, the SECT, the regulators, for whom the financial statements need to be filed, the FPI, any of the banks with which the company is working in different covenants. So these are all the users of the financial statements. So auditors should make it mind that the financial statements needs to be reviewed by whom. The second consideration is the purpose of usage of financial statements. Like the financial statements are used for the management reporting purposes, based on which the management is making decisions that whether to enter into a certain business, whether to continue with different products, what are the costs that needs to be curtailed, what are the short-term and long-term targets to be set or revised. So the auditors need himself to be very vigilant about the purpose and usage of financial statements. And the second consideration is the auditor should address the risk at relevant assertion levels. Like as an accountant and associated with the accountancy field, majority of us are known that there are certain assertions on the part of management that they provide assurance to the shareholders, stakeholders, that these are the things that they have checked and make sure that financial statements comply with these parameters. So these assertions are understanding and classification, like the transactions are properly classified and are properly recorded in relevant account heads or codes, the presentations and disclosures, that all the asset and liabilities that needs to be on the set of financial statements are properly presented and are disclosed in their true sense. Also, existence or occurrence about a class of transactions or account balances is that transactions has taken place and occurred on the period which are they being reported for in the set of financial statements. Also, the entity have the rights and obligations for all the disclosed asset and liabilities on the face of financial statements. Management also assert that there should be completeness and proper cutoffs for all the transactions. It means that all the transactions that are required to be reported in a financial year is there based on the cutoff and completeness assertions. And of course, the last one is about the valuation and accuracy of the liabilities and the assets that are appearing on the face of financial statements. So, auditors should assess the risk on this financial statement level, at a consolidated level, like the users and the purpose of financial statements, and at assertions level that are related to every single class of transaction or account balances. So, what is the purpose of this combined risk assessment at financial statement level and at assertion level? It means that it is a tool used by the auditor to understand the relationship between various risks arising from an audit engagement and enable to manage the overall audit risk. Management of overall audit risk means that the audit risk is maintained at an acceptable level for the auditor to issue a proper opinion on the risk level. The next one is the assessment of risk at each component level. Like for every single class of transaction or account balance that is material to the auditor for a specific engagement, the risk needs to be looked at each and every single component of the set of financial statements. Also, the risk values that are not readily quantifiable through and professional judgment is used to assess the risk. Like there is no set of gauge that a risk needs to be quantified as. Auditor or the accountant usually use a scale to quantify the risk as high, medium, or low, or to give them a numeric value between 1 to 5 based on their criteria. Like for the 1 stand for the lowest one, the low risk, and the 5 stand for the high risk or the significant risk, and 3 stand for a medium or a moderate risk. So the auditor needs to use his professional judgment in assessing the risk for every single component of financial statement. Then there is an established relationship between the risk and take account to reduce overall audit risk to an acceptable level. Like once the auditor have established what is the level of risk in each single account balance or class of transaction. So they need to make sure that the risk and the actions taken are at an acceptable level. The last one is about the higher the audit risk, the lower is the maturity level assessed. It means that whenever auditor assess audit risk is higher, they will assess that the maturity level is low. It means that even the lower account balances or class of transactions will become material for the audit engagement to be checked for test of details or substantive testing, in other words, that we call. Now have a look at the overall combined risk assessment process that is revolved. That at the initial planning level of the auditor will make sure that he identifies all the risks that are relevant to the business, to the entity, to the nature of transactions that they're going to test during the engagement. For identifying risk, when they have identified the maximum possible risk, the next step is they will develop a risk assessment criteria for the engagement. For every single risk that is pass through the criteria, they will assess whether the risk is high, moderate, or low. What is the likelihood? Is it very likely? Is it possible? Or is it remote to occur? Then they will assess risk interactions, like how one risk is interacting with other components of the risk. And based on that analysis, like there are certain techniques that we use to assess risk is to plot them in a heat map to see which of the risks are higher in terms of their likelihood and impact, they are more significant, and the risks that are not very high is moderate or low and is not likely and have a lesser impact that are not very significant risk, they need to prioritize the risk. So once they have prioritized the risk, they will respond to the risk. And respond to the risk means the auditor will develop and modify their audit procedures to make sure that these audit procedures reduce the overall audit risk to the acceptable limits. If in the lower part, you can see the audit risk is equal to the inherent risk times control risk times detection risk. So it means that audit risk derives its value from all the three components of risk during an audit engagement. If you look at the audit risk equation, you will see the inherent risk and control risk are highlighted in a circle. This is because of the reasons the inherent risk and control risk are not in control of the auditor. The inherent risk derives their value from the ecosystem and the nature of entity's business, as well as nature of transactions that are there engaged with. And the control risk, that is also not in the hand of the auditor because the internal control system is developed and managed by the management, and they're responsible to make sure that the control environment is properly and effectively working. The auditor has their plan to alter or modify the detection risk. Detection risk is based on the procedures that the auditor will apply to a specific engagement during the course of the audit to make sure that the audit risk is within the acceptable limits as determined by the auditor during the start of an engagement. So the first one was that how to prioritize risk, and once they are prioritized, how auditor is going to respond to the risk. And then we have a look at the audit risk equation, that how it derives its value from the three components that we looked into more detail earlier. This slide is about the audit risk metrics that are used. It's called a heat map. Like say, for example, we classify our control risk into three categories like low, moderate, and high for a certain class of transaction. And similarly, that class of transaction do have an inherent risk in itself. And we also classify the inherent risk as low, medium, or high. So if we plot the risk in these 9 boxes in the red area, it means that this is a significant risk that auditors need to address. Let's take an example. There is a class of transaction like cash and bank balances. The inherent risk in cash in hand is relatively higher due to the inherent nature of cash transactions. However, management has implemented a very tight control over the process. Like they have given a upper limit, impressed limit for petty cash. They have developed a very comprehensive policy to ensure which transactions can be settled through cash, and they have proper controls over preparer, reviewer, and approver of these cash transactions, and these are properly recorded and documented by a separate team, or there is a segregation of duty between different teams. So in this case, the control risk will be at the lower or moderate level. So if it's low or moderate, the overall risk factor is moderate, like 3 in terms of inherent risk and 1 in terms of control risk. So the overall assessment will be moderate for cash in hand. On the other side, if you look at the same cash transactions in an entity that doesn't have a proper cash management policy and there are no proper control on authorization or segregation of duties, the control risk will be very high as well. So in that case, the risk will jump from moderate to higher. It means that the detection risk needs to be very low to make the overall audit risk to within the acceptable limit for the auditors. So usually during the planning stage, we perform this sort of analysis for all the key loss of transactions and account balances to make sure that the overall risk stays within the acceptable limit for the auditor. So I want you all to remember this equation that audit risk is equal to inherent risk times control risk multiplied by detection risk. So if we need to rearrange the sequence for this equation, we can always say that the detection risk is equal to audit risk divided by the numerator, inherent risk, and the control risk. So if you look at this equation, we have to define the audit risk like low, medium, or high, and then we multiply the factor, the inherent risk and the control risk. And if the denominator will reduce, it will automatically make sure that detection risk is high for a certain level. But if the audit risk remains the same and numerator is increasing, the overall detection risk needs to be low for a specific engagement. So this is an equation that determines what are the audit procedures like the test of details and analytical procedures that are required to make sure the detection risk stays at a very low level or acceptable level to reduce the overall audit risk within the acceptable range for a specific audit engagement. So what it means that previously we discussed that auditor, while assessing the audit risk, will make sure that he assesses the risk at the financial statement level as well as the management assertions level. So once the auditor had reviewed the risk at the financial statement level and make sure that which of the account balances are material and immaterial for engagement, then he moves toward the assertion level, what is understanding and classification, the presentations and disclosure, existence or occurrence, rights and obligations, completeness and cutoff, and valuation. Mnemonics that we can use to remember this equation is you perceived. So you, PERCV, will help you out to remember all these management assertions in an audit engagement. The objective of testing these assertions for a specific class of transactions or account balances is to modify the audit procedures that are required during the substantive testing of the engagement. Like we have in our hand the test of details and analytical procedures. If we look at the test of details, there are certain ways, that is inquiry, confirmation, observation, recalculation, reperformance, and inspection of the audit evidence or a transaction. Like in an inquiry, we can simply go to the management or the persons executing the transactions, that how they are performing the transactions and how they are recording it out, and what sort of process they follow from initiation to termination of a transaction for any specific head. But inquiry itself is a weak audit procedure to perform. It is just used to assess the process that is being implemented and to document an understanding about the existence of a process for the test of details. The next one is confirmation. This is an audit procedure that the auditor usually performs for the asset and liabilities, like to make sure that the entities have the rights and obligations for an asset, for a receivable, and as well as a valuation that has done for a liability can be confirmed by a third party to make sure that there is there. Observation is also part of a substantive procedures that they can observe that how the transactions are being recorded and being reported, entered, approved, archived, and retrieved. So auditor can add observation into the test of details. In parallel, to gain some evidence, auditor can also perform recalculation. For example, there is a schedule for calculating accruals or deferred liabilities. So the auditors can recalculate all the details to make sure the calculations are correct and gain an understanding of the procedures and also reperformance. They can themselves obtain all the liabilities detail and see if they have the same numbers that has been reported in the financial statements. So the recalculation and reperformance, these both are a very strong audit procedures to support any of the assertions that are there by the management in the set of financial statements. Last but not the least, the inspection. Auditor can define a procedures for any class of transactions or account balance to inspect to make sure that they are properly presented and disclosed. The transactions have occurred or existed. It was complete in all material respect and being booked and recorded on an accurate basis. So all these procedures, inquiry, confirmation, observation, recalculation, reperformance, and inspection are defined as just those details that auditors do have during the course of an audit engagement. The second portion of the substantive testing is the analytical procedures. Most of you would have known about the analytical procedures. It's about the analysis, like a predictive analysis of the trends that are there. You can have a horizontal analysis or a vertical analysis, like on year-on-year basis, month-on-month basis, and a main transaction and then sub-transactions. The component of that, you can perform certain ratio analysis, like you can perform for some assets, you can go through the trends in the current ratios. For inventory, you can go into the inventory turnout ratios for different years. For different years, you can look into the debt equity ratios and the gearing ratios for the entity, and of course, the profitability ratios. So these are all the analytical procedures that are also part of the substantive testing by the auditor during the course of an audit engagement. So once we have looked at the audit procedures, these audit procedures are used at the planning stage, like once the audit risk is being developed, auditor has an understanding about the inherent risk, the control risk, the detection risk, and the level of audit risk that is acceptable for the engagement. Then the auditor moves toward the procedures that will be required for making sure that detection risk stays on the low side and the audit risk stays at an optimal size for giving an opinion for the financial statements. We have already discussed about the test of details and analytical procedures. So all these procedures, the test of details and analytical procedures, are performed for the class of transactions, like the all sort of revenues, the direct revenues, the indirect revenues, the direct cost, indirect cost, and the associated components for all the both categories, and the account balances, the equity, the liabilities, current, non-current, both tangible assets, non-tangible assets, and current and non-current as well. So all these procedures needs to be defined very clearly for all the material class of transactions and also for all the material account balances for expressing an proper opinion for a set of financial statements during an audit. If it is to give an example about the a set of financial statements and disclosures, there are certain assertions attached to it. Like the first one is the completeness. If you go to the completeness, and for this, the inherent risk is usually higher for a client that doesn't have a very proper and thorough implemented financial reporting process as part of internal controls. So the inherent risk for completeness is usually high that they have not recorded all the transactions in the accurate period for which the financial statements are prepared. But for example, the auditor is going to rely on the control risk because they will test certain transactions based on a sample and then will assess the overall combined risk assessment is low. If you look at the management, measurement, and valuation acceleration, usually it also remains on the higher side for the assets that require the estimate and management judgment to mark and value any of the asset and liabilities. But you're going to rely on the control. The combined risk assessment is low, but there needs to be special procedures that need to be developed by the auditor to make sure that the measurement and valuation for an asset or liability is correct. Let's take an example for the valuation. For receivable, there are usually the valuation assertion is there, and you calculate the risk. Inherent risk is high that the receivables might not be valued properly because of the provisions. Like the management have a policy for the writing off some receivables. Like they say, like 50% of the receivables will be written off if they are older than 6 months, and 100% receivable will be written off if they are older than 1 year. So if the management changes the policy, the provision and the classification of the receivables will change definitely in terms of value. So the inherent risk will usually be on the higher side. But if you say the management have implemented controls, they say that we have a process for making sure the policy is implemented in its true sense and spirit. So they can perform the test of controls for this set of receivables, in which way they will look at the aging, they will obtain aging of receivables from the management. From the aging, there will be certain brackets like 0 to 30 days, 30 to 60 days, 60 to 90 days. They will pick up some receivable based on certain invoices, and then will see that if they are appropriately recorded in the aging classification, and based on a sample size, they will determine that whether the control risk is low. So the specific procedures devised for gauging accuracy of aging report is called the special consideration procedure for this account balance. Similarly, for rights and obligations, usually for rights and obligations, the inherent risk is higher. That entity is recording certain assets at a higher price and is not disclosing and marking its liabilities at per the proper value that is assigned. So they are just marking that disclosing some guarantees as a contingent guarantees or some proper liabilities as a contingent liabilities in the set of financial statements. So usually for rights and obligation, for such things will remain higher. But of course, if the auditor decides to rely on the controls, they will perform the test of controls, and from there, the overall combined risk assessment for that set will be low. The same goes for premeditation and disclosures. It is very possible that management may not disclose all the assets and the liabilities on the face of financial statements. So the control risk can be relied upon based on the fact that auditors will perform some specific consideration and will perform certain procedures to make sure that all the liabilities are properly recorded and all the assets are also appearing on the set of financial statements that are needs to be presented and disclosed. This is called an audit risk matrix. Like we discussed earlier in a heat map, that inherent risk and the control risk can be marked as low, moderate, or high based on our understanding of the entity and the nature of transactions the business is engaged with. And against each single category for inherent risk, we have marked the control risk. Like the control risk can be also low, moderate, and high, as we plotted all these three combinations on the heat map. I hope you recall this heat map, where the inherent risk do have a three categories: low, moderate, and high, and as well as the control risk is also having three categories, like the low, moderate, and high. And in total, there are 9 different set of blocks that are appearing. The three are the low or minimal risk, three with the moderate risk, and three with a higher end risk for both of these factors. So just marking that in case our inherent risk is low, and also we assess the control risk is low, low multiplied by low will give a minimal factor for the audit risk. And it means that if the overall risk is minimal, the substantive assurance required is low as well. Like the substantive testing or the test of details and analytical procedures can be reduced to 50% of the total population. Similarly, if the inherent risk is low, but the control risk is moderate, the internal control multiplied by control risk, inherent risk and control risk comes to low. Low is a bit higher category than minimal, so it means that a little more level of assurance is required through substantive testing. So the substantive assurance will be around 63% of the total population. But if at the planning stage, the auditor presumes that inherent risk is low, while control risk is high, the combined factor will be a moderate one, and which means to reduce the overall audit risk, a more high level of substantive assurance is required, and that is 86% of the total population. And if you move at the next bracket of the inherent risk, is the moderate one. Inherent risk moderate, control risk low, and overall low factor, and it means a 63% of the foundation testing during test of details. And both internal control risk and inherent risk moderate gives the moderate factor, which means that the overall percentage needs to be around 86% of the total population. However, if auditor presumes inherent risk to be low, moderate, and control risk to be high, it yields a high factor that is required for the as a component of audit risk, and that means a much more higher level of assurance, subjective assurance, is required during test of details, around 95%. Similarly, inherent risk high, control risk low, overall risk factor moderate, 86% assurance. Inherent risk high, control risk moderate, overall factor high gives you a 95% of assurance. And if both the risk factors are high, i.e. control risk and inherent risk, the overall risk factor will remain high. It means the overall 95% of assurance. So that 95% of the population needs to be tested through certain procedures to make sure that auditor have a fair basis to give a proper opinion on the set of financial statements. So this is an overall look at the initial two factors of the audit risk, that the inherent risk and the control risk, and what is their correlation with the subjective assurance that is required on the face of financial statements. Similarly, there is a direct relationship with the audit risk and the amount of evidence that is required to be retained by the auditor. Usually, as we discussed earlier, the acceptable audit risk is either low, medium, or high. And this audit risk derives its value from the three components, like the inherent risk, the control risk, and detection risk. And once it derives its value, the amount of evidence required is based on the acceptable audit risk. If you look at the first one scenario, acceptable audit risk for engagement is high. It's fine for the auditor to issue a report based on certain assumption. So in that case, if the inherent risk is high, control risk is low, plan detection risk is high, the overall amount of audit evidence will be required is low. This is because an auditor is willing to accept a much higher is low. And if an overall acceptable audit risk is low, a much more medium level of audit evidence is required. But then, if for a business, for engagement, acceptable audit risk is low, however, during the planning phase and the combined risk assessment, the auditor determines that the inherent risk is high, control risk is high. It means that the factor is very high. If in the third one, we saw that this is the last one where inherent risk is high, control risk is high, the risk factor remains high, so the subjective assurance is required 95%. So here, even if the acceptable audit risk is low, due to the high level of inherent and control risk and low level of plan detection risk, the amount of evidence required will be high. Like say 95% of the population from a specific account balance or class of transactions will have to be tested, and the evidence needs to be retained as part of the working paper for the auditor. In the fourth scenario, if the acceptable audit risk is medium, what it means, the inherent control and plan detection risk are at all medium level, the amount of evidence required is also medium. Say, for example, 60 to 80% of samples need to be tested for its accuracy and all the management assertions that are associated with that specific account balance or class of transactions. And in the scenario 5, if the audit risk acceptable is high for the auditor, but the control risk is and detection risk is medium, overall amount of evidence that is required to support an auditor to base an opinion on the set of financial statements will be medium. So this overall means that the audit risk is directly proportional to the detection risk, and this is also associated with the amount of evidence that is required. If the acceptable audit risk is high, usually the amount of evidence will be low, and if the audit risk that is acceptable for the auditor is low, the amount of evidence that is required to provide assurance on the set of financial statements will be on the higher side. But having said that, there are certain other factors is the level of inherent and control risk, and as well as planned detection risk for the engagement that determines that what sort and what level of evidence that is required during the specific audit engagement. Now, if we have looked at certain things, there are certain considerations that why auditors can deploy certain techniques to make sure that the audit risk is minimized and stays within the acceptable limit for the engagement. This is a bit, you can say, a summary for all the techniques that auditor can deploy to make sure that the audit risk remains at a minimal level. The first one is a proper engagement with the audit management. Why is this required? This is to make sure that the auditor properly and duly understand the nature of the business, the products, and the environment that they are operating, to make sure that they are familiar with the ecosystem of the business, and as well as the nature of transactions that are being performed by a specific entity. So the engagement with the management from the client team is very important and pivotal in making sure engaging the inherent risk for a certain assignment. The next one is proper audit planning and selection of appropriate audit procedures. Once the auditor has completely understood the business and the practices, the processes, the policy and procedures, the ecosystem, the nature of transactions, then it is very important for the auditor to perform a proper and comprehensive audit planning to make sure that they have very clearly defined the materiality level for the engagement. Also, they have properly marked the level of detection risk for certain procedures, and then based on the assessment, they need to deploy and develop proper and appropriate audit procedures for every single material class of transactions as well as for the account balances. A very pivotal and a very vital factor is the audit team who is going to perform the engagement. So in order to make sure that the audit risk is minimized, an audit team should comprise of all the team members that have sufficient knowledge of the business and the transactions that are being performed through that audit level. Like usually in audit firms, both locally and internationally, you see that there are certain departments. Like for telecom services, there will be separate departments. For oil and gas sector, there will be separate teams. For banking sector, they will have specialized team. For development sectors, and similarly to gauge other manufacturing concerns, they have different teams. So they have the team with the sufficient knowledge about that specific business, nature of business that is required to be engagement. And next one is assessment of internal control system to gauge control mechanism implemented. It is the responsibility, as we discussed earlier, of the management to make sure that they have clearly defined their policy and procedures for all the categories of assets, liabilities, revenues, cost, the way that they will perform and they will authorize and they will record. So to make sure that the auditor is cognizant of the fact that a management have properly deployed internal control systems and procedures, and then they need to gauge them to make sure that the internal control system is effectively working as defined by the management during the initial planning cycle. Also, auditors need to make sure that sufficient time is allocated to the team for analyzing financial statements. They should not be pushed for unrealistic deadlines. This is because if a team is given a proper time, they will ascertain with due care and proper knowledge about the things that are required for the testing purposes and to make sure that they have an opinion about the tasks that are being delegated to them. And that opinion will, of course, will be consolidated and reflected into the overall opinion for the financial statements. Auditors once have a thorough discussions with the management and have completely understood the business environment and the ecosystem and the nature of transactions should customize nature, timing, and types of audit procedures that they are going to perform during the course of engagement. And of course, based on these audit procedures, the timelines for the audit field work needs to be agreed between the auditor and the client management. Auditors should also be cognizant with the fact that material definition is very important for every assignment. And if they have gauged and marked the different type of risk, the inherent risk, the control risk, and detection risk, so that will help them to ascertain and set the materiality level for a specific engagement. As most of you know that are associated with the firm, that materiality is the factor that is required to include or exclude any of the sub-accounts of class of transactions and account balances from the scope of an audit and subset of details. So if an account is material, of course, all the associated procedures needs to be marked to that level. Usually there is a misconception about materiality is that the materiality factor is only based on quantitative factors. Like say for example, for a set of financial statements, we have defined that for all assets and liabilities, $10 million will be a material amount. It means that all the accounts that are above this threshold are material for the engagement to be tested. But there are certain qualitative factors as well. Like there is an accrual legal fee that is under $10 million. But that is very critical for the auditor to make sure that he go into the qualitative aspect of every single account, class of transaction or account balance to make sure that if there is a qualitative factor that is very critical for the business, that needs to be material for that specific engagement. And last but not the least, the auditor should ensure proper and adequate sampling techniques. That sampling is based on certain prerequisites. It should be a random sample. At the later part of the session, we will look into the sampling, that how different samples need to be generated. Like if, say, for example, there are 4 different kind of revenues, products that are contributing to the revenue, samples should be representative of the all 4 different products. Then from all different 4 products, there are certain subproducts. So it is the responsibility of the auditors to make sure that they have covered all the products and subproducts for a material account within a sample tested, selected for a testing purposes. So by deploying all these trade and techniques, the auditor can facilitate himself by minimizing the audit risk and maintaining it to the level that is acceptable for the engagement and that is required for the auditor to properly express and base his opinion over a set of financial statements during the course of the audit. Please make sure that this is a very comprehensive, a very detailed subject, how the planning is, how the risk assessment is performed, in the risk assessment, how the critical accounts are marked, how is materiality set, and based on the materiality, how are the audit procedures defined and the sampling techniques developed. So in this session, we just try to summarize all the key portions or the key points that one needs to keep in mind while engaging what the audit risk is, what are the components for the audit risk, how every single component is calculated, what are the sources from which that risk derives its value, how a risk can be classified within low, moderate, and high category, and what are the factors that are in control of the auditor, like inherent risk and control risk is not in control with the auditor. The auditor only have control or can exercise some level of control on the detection risk through proper customization of nature, timing, and extent of audit procedures, and also by keeping in mind certain key consideration for any specific audit engagement. And based on all these trade and techniques, the overall audit risk can be minimized. And one of the key taking from this session was that the auditor needs to assess the audit risk both at the financial statement level. I have already repeated it, but for the sake of making it significance, that auditor need to make sure the risk assessment is performed at the financial statement level to make sure which of the account balances and class of transactions are significant and sensitive, and as well as if they have selected the class of transactions or the account balances that are significant, associated assertions that how they're going to test any specific assertions for a proper account balance or class of transactions. I gave you an example for the receivable, that for a receivable, how the valuation assertions can be checked by looking into the policy that is there for the write-offs, as well as for the you can say the aging and the provisioning factor that determines the receivable side. So usually, as the audit has moved from a substantive audit to a risk-based audit, So knowledge of all these risk factors, knowledge of testing, all the assertions associated with every single account balance of class operation that is material is of pivotal nature. So just all of you, I want all of you to memorize all these three segments and to have firm up your understanding on the audit risk matrix, the audit risk equation, the factors, and how it is relevant to the substantive assurance, and as well as the evidence that are required from all these three sectors. So here I would like you to just, for your own understanding and brainstorming, to see what are the assertions that are relevant to the non-current assets for us, for a manufacturing concern. The industry is manufacturing. The account head, account balance is non-current assets. What are the policies that are required for uh, for valuing the assets? What are the policies that are required to capitalize the assets? And what are the assertions that are linked to the existence of an asset, and how you can make sure that the entity has a specific right and obligation for the assets. Similarly, you can also define certain procedures to make sure that all the assertions that are relevant to the non-current assets are properly tested, and the risk for those assertions are kept at a very minimal level for that specific industry. So just I would like you to take a minute and just think what are the policies that are relevant to the non-current assets, and how each single assertions required to be checked for the non-current assets. I just opened the slide for you that have the management assertions on your left-hand side and the audit procedures on the right-hand side. And just keeping in view both of these, just try to jot down few things that are relevant for the non-current assets.
Rizwan, can you hear me?
Yes, I can hear you.
All right, so I just wanted to find out, we have about 40 questions lined up. Do you think we can take questions right now?
We can take this question after 5 minutes. I will explain the question that I have for the thing for the non-current assets. So
Fine.
after I finish, we will start taking questions, right?
Okay, perfect. Your call.
Okay. So most of you would have jotted down your procedure. Just to start with the first assertion about the understanding and classification. An entity, if it's a manufacturing concerns, needs to have a very clear policy for the bifurcation within non-current and current assets. The second policy they needs to have is about the capitalization, that above which value and above what percentage of completion an asset will be capitalized from work in progress. The further assertion of permutation and disclosures, you can test that if these policies are applied in a true sense and spirit about the existence, you can physically inspect the asset and observe the work in progress. For rights and obligation, you can always go for a confirmation from the third party from which the asset was acquired, or inspection of the physical documents that are available with the client about the rights and obligations for the asset. About the cutoff and completeness, you can perform a calculation for the amount of asset that is capitalized, and for valuation and accuracy, you can ask the management and put an inquiry or confirmation about the policy for depreciation and amortization. And based on that policy, you can perform the recalculation and reperformance for the amount that is being capitalized during the year in the period for the specific account head for the non-current assets. So I hope this is how you customize a procedure for making sure that you understand the management assertions and the associated audit procedures for every single account head or account class of transactions. I hope you will have a bit of idea, but with some more practice, you will master the skills of doing it right now. So Harun, can we take the questions for next 10 minutes?
Yes, sure. I'm not sure whether we will finish them in 10 minutes. But it only depends on you how quickly you answer them. So let's go sequentially. So the first questions first. I'll be very, very quick. The first question was by Usman Khan. He's saying, with reference to the auditor, could inherent risk be associated in any way?
Yes, we are. As an auditor, it's very critical for us to make sure that we gauge the inherent risk in true sense and spirit. This is because, first of all, we need to have an entity's information. And entity information means that we need to tailor out all the audit procedures for the specific entity and the business model, and also for the nature of transactions that they are performing. I agree that inherent risk is not in our control, but based on the inherent risk calculation, we can modify the detection risk. The auditor can always modify and extend or decrease or increase the size of the sample for being tested. So indirectly, yes, auditor is required to assess the inherent risk to make sure that the substantive procedures are in line with the audit requirement.
Okay, the next question is from Syed Saad Haider. He's saying, what if the audit reports have been issued as unqualified reports and later a fraud has been unearthed and it was done in the last audit period? Will it be the responsibility of the auditor? Is he liable?
Actually, in the start of the session, I explained that the auditor is not giving an absolute assurance over the set of financial statements. If they are working, they are of the opinion that all the information have been disclosed by the management. If you look at the inherent risks, the slide that I've opened, the last bullet is the integrity of the management. For this portion, auditor usually obtains a representation letter from the management that they are disclosing all the facts and figures on their best possible knowledge. And based on the information provided by the management to the auditor, they perform the audit assignment. And if from the sample selected, they have performed their duty with all the ethical standards that they have, and laterly it is disclosed that there was a fraud that was not detected, either due to the concealment by the management or due to the sample that was selected by the management. So it's not on part of the auditor if they prove that the negligence was on the part of the management to conceal a fraud. As I explained, the inherent risk and the control risk are not in control of the auditor. They are towards the entity. So the detection risk they can define. So if the fraud was concealed and the auditor was not able to select a sample of transactions that were involved for that, it means that laterally, yes, of course, he is not responsible. But if it's come to his knowledge, the next year financial statements, the previous year balances needs to be revised for all the amount that was disclosed as a fraud. So the comparative for the previous years will have to be adjusted to account for those frauds.
Okay, the next three questions are from Shoaib Ahmed, and I can ask all three questions in one go. The first one is, can you give some examples of financial statement risks? Number two, can you provide some important elements to prepare risk assessment criteria, quantitative or qualitative, while scoring risks? And the third element is, please explain risk interaction.
Risk interaction, okay. The first one was the set of the answer was about the financial statement risk. So the financial statement risk are usually that your transactions are not properly recorded, are not recorded in the correct period, are not properly valued. These transactions that are being posted are not properly approved or endorsed, and are not properly archived. So, and like say for example, our entity has a policy to approve monthly accounts, and they're not approving those monthly accounts. So this is the financial statement risk. The monthly accounts are not approved by the management. For financial statement risk, if that for every change in policy for depreciation or amortization, there needs to be approval from the top tier of the management. So there is a risk the policy was changed and the proper approval was not taken. So these are the sort of financial risks that are there for every single business that it entails. The second one was the answer was about the assess risk interactions. It means that there are certain different categories of risk. Like for an entity, there can be some reputation risk, there can be some compliance risk, there can be some, you can say, financial risk. So a single risk has a multiple dimensions involved to it. Like, say for example, we can take an example of customer churn. So if the customer are churning because of the negligence of the management, it's a reputation risk. It's also a regulator risk that they are not following the criteria set by the regulator. It's about the management risk. The management is not performing their duties as part of it. They are not complying with the policies to make sure the churn is stopped. So in this way, every single risk has multiple dimensions involved to it. And also, of course, if a customer is not being retained by the entity, the revenue overall will decrease, and it's a decrease to the revenue. So all the risks have multiple phases, and they are interrelated. And Harun, I forgot the last part of the third question by the person. Harun, can you hear me? Harun, can you hear me? Please can you check the connection?
Rizwan, am I audible? Hello.
Yeah, I can hear you now. What was the third question?
The third question was about risk interaction. So,
Yeah,
please explain.
I just explained the risk interaction, that every single risk has multiple dimensions. A single risk can be a reputation risk, that can be a compliance risk, that can be a regulatory risk, that can be a revenue churn risk. So a risk has multiple phases to it. So an auditor need to make sure that he is cognizant of the fact that what are the dimensions of a single risk can be.
Yeah. All right. The next question is from Irfan Mustafa. He's saying, is there a difference between test of details and test of controls?
Yes, the test of controls is related to singly to the internal control system. You are gonna assess how the internal control system is working. Is it efficient or inefficient? So it is a test of controls, and the test of details is about the substantive procedures. It's that you will take a population of say 100%, and out of the total 100% population, you will perform test of details on 70% of the population. So the test of details is based on a very huge volume of sample, while test of controls, you generally take 2 to 25 maximum transactions for assessing the internal control environment. So,
right. The next question is from Mirza Beg, and he's asking, does the client have rights to inspect audit working papers? And if you allow me, there's another question from him, so I can ask that as well. Sorry, I am piling up questions on you. The second question is, can you explain the concept of general purpose framework along with fair presentation and compliance framework?
Okay, for the first question, the client doesn't have the right to inspect the audit working papers. They can question the differences, and the auditor can present the findings in a way that these are the findings based on the evidence provided by the entity. So the working papers are the ownership of the auditor. The client do not have the right to ask for them, but yes, if there is a dispute, the auditor can always give them the evidence that these are the things that they are certain based on the evidence provided by the management. And the second one was the generally accepted principle, GAP, compliance framework.
Yes, yes. The second question was, can you explain the concept of general purpose framework and special purpose framework, along with fair presentation and compliance framework?
Actually, framework, every single entity has a certain framework for them that set up the rules and the methodologies that they will execute to perform certain transactions. So generally, like if you call about the businesses, both locally and internationally, they do have a minimum control framework. They have a maximum full scope internal control framework. They have a compliance framework. These are the criteria that they will follow to perform the financial transactions. These are the criteria that they will follow to perform the compliance engagement. Like, say, for example, take an example. An entity wants to onboard a certain vendor. So it's very risky for an entity to make sure that whether the vendor that they're conducting is a government entity, is a government associated thing, or is involved in any of the prohibited nature of business. So these sort of things need to be make sure that entity generally have maintained a compliance framework, a minimum control framework, or a full scope engagement framework that they will follow to perform operations and routine transactions.
Okay, the next one is from Rehan Yusuf. He's saying, from where did this 50% come from? What is substantive assurance? Where is it coming from? And are these percentages defined in ISA? ISA?
No, these percentages. Actually, you know what? This is the judgmental process. As explained earlier, the substantive assurance, it is based on the methodology that a firm normally adopts. These percentages are based on a review performed from the working papers from the Big Four, that what level of assurance, substantive assurance, they do provide for a certain specific account balance if it's have this level of inherent risk and this level of control risk. Like, for example, if the inherent risk is moderate and the control is moderate, the overall risk factor is moderate, then 86% of the assurance, substantive assurance, needs to provide it for a specific account balance or class of transactions. So these levels can differ from firm to firm practice, but generally the Big Four follows this sort of subjective assurance on different assignments.
Irfan Mustafa has asked a similar question. He's saying the percentage is like 50, 63% is for guidance, or is it as per ISA? So you've already explained that. But then he goes on to ask, yeah, so can we increase or decrease this percentage, say 40% instead of 50 for low or low and minimal?
Yeah, it depends on the firm practice, that what level of the overall audit risk that they are willing to take. If they are willing to take a more high level of audit risk, then of course they can decrease their subjective assurance percentage to 40% or somewhere around 45%. But again, it will depend on the firm methodology that they follow for providing assurance on a set of financial statements. It's just based on the judgment.
Okay, the next is from Rehan Yusuf again. He's saying, I understand from audit practice that software selects the transactions. I've never seen actual percentage coverage as software selects the transactions.
Actually, but you won't say that if there is a sample within a sample, of course you will give some guidance to the software that from this population you need this much sample, and from this population you need this much sample. So it's not that the software, like the Big Four usually perform audit sampling through the softwares, but yes, again you will tell that software that this is the population for a specific transactions. I need this percentage of sample from these transactions, and from this from this sample transaction. So I just explained, as I explained, there can be a revenue product, but for a product there can be some further sub-products. So in a software, you need to give a population for every single sub-product to make sure that the total number of the sample that you have selected cover and represent all the population. It's not just one population of a specific product.
Okay, the next one is from Rehan Yusuf again. He's saying the relevant details of ROM is put in, including the materiality level.
Sorry, come again.
He's saying that relevant details of for ROM, ROMM, is put in, including the materiality level. If the question is not clear, we can ask him to explain it.
So please, if you can ask him to just retake the question.
Okay, Rehan, please rephrase your question. Irfan Mustafa is asking, what do you mean by acceptable audit risk on the slide?
Yeah, on this slide, the acceptable audit risk means that for a set of engagement, the auditor is willing to take or express an opinion based on a certain level of risk that if a client is under a monitorship or is under a very tight scrutiny by a regulator, the audit risk will be very low. An auditor will be required to keep the overall audit risk low, and it means that a huge amount of assurance, high or medium level of assurance will have to be provided to make sure that audit risk remains low. If a client is already blacklisted, is already being issued a qualified opinion in the history, is on a watch list for a certain regulator, then of course for certain engagements, the acceptable audit risk will be low. It means that.
Okay, I think let's very quickly get into the end.
Yes, Arun, any other questions? Arun, I can't hear you.
Rizwan, can you hear me now?
Yeah, I can hear you now. Yes.
Sorry, there's just some voice blackout issues. So Adil Hussain is saying, is it necessary to assign a 5-scale rating? A 3-scale rating of high, medium, and low is also helpful in some way, in my opinion.
Yeah, it's purely based on the judgment. In case you are taking the low, moderate, or high rating, it's fine. If you want to have a 5-scale rating, it's fine. Even certain entities take a 7-scale rating. That is absolutely fine. It's based on the judgment of the auditor that how they want to assign ratings.
Ishtiyaq is asking same question about percentages. He says, how do you read the percentage on risk, i.e. 63%, 86%, 95%?
It's based on the analysis that is being provided by the Big Four, how they actually define their substantive procedures.
Okay. Muhammad Tariq is saying how the audit risk can be mitigated through sampling.
Audit risk can be mitigated through sampling. Actually,
Sampling.
if it is not, it's not a standalone technique that the proper sampling will make sure the audit risk is minimized. There are certain other factors that he needs to work on. Like the auditor need to understand the business and practices. They need to modify their audit procedures. They need to prepare the team with the sufficient knowledge. They need to review the transactions. They need to analyze the set of financial statements. They need to customize the timing, nature, and extent of audit procedures. So, and then they need to ascertain the materiality proper on the basis of qualitative and quantitative factors. So it is all the set of parameters that will help to reduce the audit risk to acceptable level. Only the sampling technique that will to make the audit risk minimum level. The sampling technique will make sure that you are very vigilant and very proactive in making sure that for every material account or class of transactions, you are touching every single important account in a later slide that we will discuss that how sampling techniques can be further enhanced to make sure that we select a proper sample that is representative of the total population for a certain thing.
My Sam Latha is saying, he's added a comment, say, if I may add, clients only have a right to request working papers if it is agreed in the engagement letter. So just a comment.
Yeah, it's just again I said that these are the ownership of the auditors. So if usually if you look at the auditor papers, in case of dispute, they can come up with certain things that these are the all the noting that they have done based on the information provided by the client. Because in the working paper, they do not populate anything that from themselves that is based on the evidence provided by the client. So this is their you can say the ownership, and in case they want to reproduce it, they can come up in the case of a dispute that these are the working papers based on this dispute has happened. So just make to sure that how the mitigation needs to be done.
Okay, Faisal Abdul Qadir has put up a question saying, are these inherent and control risks on entry level or transaction level?
Uh, Actually, entry level or transaction level, both inherent risk is based on the ecosystem of the entity as well as transaction level. The internal control risk is specific to the transactions from initiation till termination within the financial operation cycle.
Rehan Yusuf has put up the question again saying, we put in the relevant details for risk of material misstatement, ROM, as he was saying it, on the software along with the materiality levels, but never tell the software to do 50% or 60% selection from the sample. That's what his question was.
Yeah, the question was like that. Like if a population is of 100 transactions and there are 10 separate segments of it. So for every time, and you need to select transactions of 20. From every single 10 transactions, you need to make sure that you select 2 transactions. So you will have to set in a product that these are the range from 1 to 10 that is representing sample population of product A. Select 2 transactions, then again from the next one, select 2 transactions, and then from the next one again 2, this so on and so forth. Till the time your sample is representing the total population of the account balance or specific revenue head.
Mehboob Ahmed is saying, can you give examples of planned deduction risk?
Planned detection risk, okay. Uh, you can say for legal charges or legal fees, you can say the planned detection risk needs to be 0. You need to make sure that you will test and detect every single transaction with the lawyer, every single payment that is made to the lawyer for certain engagement, to make sure that all the legal disputes or the regulatory disputes are in your knowledge, so that for a detection risk for this account balance, like the legal fees and charges, will be 0. And you can also say for non-current assets, the plan detection risk is 10%. You can say. So if inherent risk is high, you can say more than 75%, control risk is high, more than 75%. To take the overall risk to less than 50%, you can mark a detection risk a relatively lower level to make sure that the overall acceptable audit risk remains in the threshold that you want to define for a certain engagement.
Okay, there are questions coming in now, but I'm going to lock the questions. We have about 4 questions left. I will not be putting up any more questions to this one because it's taking a lot of time. Ahmad Atta has asked a question. Please explain the meaning of acceptable audit risk and planned audit risk.
Actually, the planned audit risk is that there is all, you can say it's almost used in a synonym way, that planned audit risk is the level of risk that an auditor is acceptable for a specific engagement. So in a word, the plan and acceptable audit risk are one and same thing.
Okay, Zahir Panah is saying, please explain materiality and performance materiality. It's only be on a percentage base that our performance materiality should be lower than materiality. We have already decided for an entity? Is there any qualitative performance materiality check in audit?
Yes, as I explained, the materiality is a threshold that is defined based on both quantitative as well as qualitative factors. That you can say account balance of above 100 million PKR will be material for an audit, but at the same point of time, there is a penalty paid to the regulator of about 1 million. But if it's a penalty, you can always go to the account balance to make sure that this is non-compliance with a certain regulator thing. So you need to make sure that this account is also material for your testing. So the materiality is a threshold that is based on both qualitative and quantitative factors.
All right, the last question is from Raza Hasnan. Hira, Javed, your question has already been answered or just been answered. So Raza Hasnan is asking, what is ICOFR?
ICOFR is the internal control over financial reporting. In other words, ICOFR is the abridged name of the internal control framework. Like an entity can use the word internal control framework, the governance framework, or can the US-based entities call this is internal control over financial reporting, because all of the internal controls are directly or indirectly associated with the financial reporting process. So usually the entities call it internal control framework, but entities in US and Europe call it as ICOFR, internal control over financial reporting.
That's all, Rizwan, and I think we can now continue with the rest of the session, and then towards the end we'll have another. So there goes your 10 minutes question and answer break.
Fine, that's absolutely fine.
Okay,
I hope
over to you.
the answers to them. At the initial phase of the I explained in the start of the session was that the first half will entails about the audit risk and the components and how the specific components derive their value, and based on that how the audit procedures are developed. And the later part of the session is about the internal controls, that why are they important. And recently guys answered that internal control framework, how that is defined, and what are the testing methodologies, how is the testing methodology done. So we will cover these sort of things in detail in this session. So I just portray you a picture of a sports car. There's usually an accountant is least concerned about the sports car. But the association is that these cars are designed to race. These are designed to accelerate all the times. But usually they do have brakes. This is because in case there is a deviation from the track or deviation from the things, the car needs to be slowed down. So generally, the people says that if there is a lot of internal controls within an entity, it will delay or defer the transaction. It will pose more time for them and it will reduce the pace of the transaction. But to make sure the accountant is cognizant of the fact that the brakes or internal controls are there to make sure that to prevent the car or the sports car from any accident, to make sure that there is no deviation from the plan and it reach its destination or the point of where it is target to be. So what are internal controls? Internal controls, as explained, are all the factors that make sure that transactions are performed that are free of errors. There are less minimal chances of fraud, and every single transaction is properly authorized, recorded, and reported. In this picture, you see that there is a lot of roads interjunction with each other. And this picture depicts that usually there are a lot of processes within a business that are applicable at the same point of time, but these needs to be redirected to their specific projection or trajectory to make sure the fluency in the flow. So a company life is the same, where there are a variety of business processes and that are overlapping with each other. And controls are very important because they are embedded in everything we do. So whatever an entity is doing, like its recording, its operations, its sales, its technological aspects, all of these are under certain controls that are defined to make sure that the company or the entities achieve their specific objectives. Why internal controls are beneficial and why there was a need for the ICOFR or internal control frameworks by the entities. Like in early 90s, there was some scandals in the world that actually shocked the whole business environment. The first one was about the Enron scandal. Most of you would have been aware of that. That Andrew Foss, the Enron CFO, arrested by FBI, served 6 years. CEO Jeff Shinkin served 14 years. And based on the Enron scandal, the Arthur Anderson, the one of the largest auditing firms, like before now there are big four. Previously, Arthur Anderson was leading the auditing business, so it was liquidated because of this scandal. And there was again a very renowned scandal about in WorldCom where the CEO was sentenced for 25 years, and similarly WorldCom CFO was served for 5 years. So in all these mega financial scandals, the entities were forced to lose hundreds of billions of dollars in shareholder values because a lot of was there for the fines, a lot of sanctions were imposed, a lot of you can say the charges and penalty was levied by different regulatory authorities within US and UK in the European markets. So that initiated a rise need for all the businesses to make sure that they comply with the internal control requirement. And there was an act called as Sarbanes-Oxley Act, was promulgated in 2002 by two senators in the US. And the purpose for the act was to make sure that all the entities that are listed on the New York Stock Exchange, NASDAQ, needs to have a report issued by the auditor on the internal control processes and the framework prior issuing an opinion on the audited financial statement. The purpose for this act was to make sure that the financial information is produced based and through a certain processes and procedures that are there, and the auditor need to make their opinion about the process through which the information is provided, that if it's accurate and will prevent errors and frauds in any possible way, and the information will be reliable and can be used for other purposes. So these things gave rise for the entities and the businesses and the emerging business needs to have a proper and very well defined internal control framework for all the entities. So what are the controls and characteristics? Generally speaking, there are three types of controls that we have for every single business. And these things can be applicable to any of the business segments, any of the different entity, either it's manufacturing, it's technological based, it's development sector, or it's the financial institutions. So there are certain preventive controls, there are certain detective controls, or there are certain directional controls. So if we have a look at the preventive controls, it says a very crude example is about the door lock. You can prevent a person from entering a position that he is not authorized to. Bank card limits, you can impose certain limits on certain cards. These are the preventive controls. Similarly, you can authorize a person to approve a transaction to a certain level, and after that there will be joint signatories or joint approvals. So that is again sort of preventive control, that at the first part of the transaction there are controls to make sure that there is no error or minimal chances of fraud. So these are the preventive controls. And if you look at the directive controls, detection control, the detection controls are the control that in case there is some error that was not prevented by the preventive controls, these are detected and remediated at an appropriate level. For example, month-end reconciliation, stock counts. A very common example of the month-end reconciliation are the bank reconciliation, like to highlight the areas or the transactions that are taking a lot of time to clean or you can say clear them from the banking systems. Or the month-end reconciliation is about the asset reconciliations or the liability reconciliation to make sure that all the balances that are there are reconciled, and there is an opening balance, there is a closing balance, and the movement in between represents the amount of transactions that have been done during the period. So these sort of reconciliation are prepared by the preparer who is doing the transactions, and these reconciliations are reviewed at a different level and are approved at a different management level to make sure if an error has happened, that is, if the first approver is not able to detect the error, the second approver is detecting the error, or the third approver will make sure that this is detected. And certainly, in similar way, the stock counts help enable the management to make sure that the physical inventory is tied in with the inventory in the ERP or in the stock modules. And the third type of controls are the directive controls. And the directive controls gave their value from the internal policy and procedures that are defined by the management. Like we took an example that for employee hiring, there will be a policy to hire an employee. For approving expense claim, there will be a policy for expense claims. For asset valuation, there will be a policy for depreciation. For petty cash limits, there will be a petty cash policy to make sure there is an interest limit and how the petty cash will be reimbursed. And then, of course, there is a recording, how the financial transaction will be recorded in the systems. So all these are policy and procedures are the direct control that the management are have defined in the system to make sure that the type of controls are aligned. So every single control, whether it's a manual control or IT dependent control, they have certain characteristics. Like it will be based on a system. If it's a system like generally the Oracle, this SAP, SAP, the Sun software, or any of the auditing software, they have some application embedded controls. Like there will be a access management control, there will be a entry level control, there will be a restriction to certain modules and things like that. And there will be a three-way match sort of a control. A very good example of a three-way match is for the entities that have automated procurement module, automated payment module, accrual and booking module. So, for example, if entities have issued a purchase order for a vendor, the invoices there from the vendor, the module will reconcile the purchase order, the amount in the purchase order, and the invoice value. And then, of course, if the invoice is approved in the system, the recording for the payment or the you can say accrual in the system. So it will be a three-way match like PO, invoice, and payment. So the system will make sure that invoice cannot exceed the purchase order value, and similarly the payment cannot exceed invoice. So these are the system embedded controls that usually are there for a organization that have a mature system. There are certain IT dependent controls, both system and manual. Like for example, review of exception report produced by the system. That if there are struck transactions, or if you can say like we cannot have a petty cash reimbursement for more than 10,000 rupees, and if you look into the system, it will not allow to enter a transaction that is there for more than 10,000 rupees. So these are the IT dependent controls, and if you will try to bypass the system control, there will be a session report available to see like which of the transaction amount were bypassing the value assigned by that. Then there are certain other manual controls in some subset of entities that are authorization of purchase orders. Like usually they will say that they will define in their procurement policy or the procurement manual that there will be certain different thresholds of purchase orders. Like a purchase order of less than 10,000 will be approved by the departmental manager. But if the purchase order is between 10,000 and 1 lakh rupee, it will be approved by the procurement manager as well as the head of department. And if it's more than 1 lakh and is under 1 million rupees, it will be approved by the CFO. And if it's more than 1 lakh or 1 million, it will be approved by the CFO and the CEO or any of the chief officers in the entity. So there are certain manual controls can be there for every process that is defined. And then, of course, a very important concept in the accounting and the accounting process is the segregation of duties. That what are the segregation of duties? And we will have a very thorough look into the segregation of duties in the next slide. So these are the type of controls that are there. So generally speaking, there are three types of controls. The preventive. The first control is there to prevent a fraud and error. Then there are detective controls. These are to make sure that if case there is an error or chances, these are not undetected and are, if detected, being remediated or corrected at the same point of time. And then there are directional control or the directive control, you can call it, that entails the entity's policy and procedures to provide guidance to all the users or all the people engaged through the financial and accounting processes. And in the later part, we looked at the characteristics that generally are there for the control. It's the control can be system-based, it can be IT dependent, it can be a manual control, or of course, it can be a segregation of duties. Now have a look at it. What is the segregation of duties? Segregation of duties means that it is dividing or allocating tasks among various individuals, making it possible to reduce the risk of error or fraud. SOD is a key concept of internal controls. What it means that it has four components like the custody, the authorization, the record keeping, and reconciliation. So in an ideal scenario, a single individual will have responsibility for only one single component. Like for example, if there is a transaction, the invoice will be received by a different department. It will be sent for recording to a different team. If it's being posted, it will be authorized at a different level. Record will be archived by a certain record keeper, and at the month end, a reconciliation will be performed for that all the payments and invoicing and receipts at a different level. So, in an ideal scenario, all these four components for a transaction will be performed either by a different individual in the same team or by different teams within the same department. So, generally, if you speak for segregation of duties, either it's the inter-team segregation, like there are three different teams performing three different tasks. One is performing the bidding process in a procurement, second is performing the evaluation process, and the third one is performing the authorization or approval process for a single component for the procurement cycle to get completed. Or it can be intra-team segregation of duties. Like within a team, there are 3-4 different teams performing a task at a different level and at different hierarchies. Like a work of one is reviewed at a different level, at a higher level, and being approved at a more higher level and authorized by a head of department. So there are 3 to 4 individuals involved in every single transaction. This is a very prime concept in internal controls. So you would have usually heard this word that we need a lot more segregation of duties in a different task, in a different area, in a different team, in different organizations. So this is the concept behind that the custody, authorization, record keeping, and reconciliation will be performed by different individuals or at different level. It can be either inter-team or intra-team. So there are a few examples to it. The first one is an employer who is initiating the payment should not have right to approve this payment. So the payment is being initiated by a different employee within a team and is approved at a different level or a different person. And of course, if you step up a bit further, the approved transaction payment is entered in the system by a different individual. So again, there are certain levels that you can assign for segregation of duties. The large scale entities, they have a large budget for different individuals, can hire a lot of team members, can have a lot more segregation of duties. And on the other front, for small and medium term enterprises or even small businesses, they don't have any uh, uh, different teams for performing different tasks. Usually they have 1 or 2 accountants that are performing all these duties. So in that case, it's a bit more, you can say, subjective concern that how they can mark segregation of duties within their team. And the second example is that employee who has system rights to write off inventories should not be their custodian. Of course, if these two individuals are the same, like inventories in the custody of a storekeeper, if there is some obsolescence, that is abnormal wastage, he can write off the inventory at his own disposal. So he should not be authorized to write off the inventory in the system. So the first thing is the inventory should be maintained by a custodian, and he doesn't need to have the right in the system to write off these. The write-offs need to be approved at a different level and to be posted in the system by a different team or a different level. The last but not the least of an example is that other than cashier should perform monthly reconciliation of funds in cash desk. Of course, if the cashier is doing the reconciliation and he's out of cash and he's short of cash, he will try to conceal the amount in the reconciliation that is there. So if it's the cashier, a reconciliation should be done by different team members and should be reviewed and approved at a different levels within the team or different teams. So these are a few examples of the segregation of duties that work of one should be reviewed and approved at a different level. So there is no conflict between posting these things. Like a cashier should not perform his monthly reconciliations. A custodian of inventory should not have the right to write it off. And simply, and the last one, the employee who is initiating a payment, she should not have right to approve it. Because in this way, if he has entered a different payment, it will go undetected. So to make sure the transactions are recorded, approved, and properly documented and archived, these should be approved and executed at different management level with different individuals. And what are the techniques to assess the internal controls? So whether the entity have proper controls or not, we usually have 4 techniques to gauge the internal controls. The first one is the reperformance. The next one is examination. Then we have observation, and then we have inquiry. So if you recall from our previous discussion in the auditor section, that what are the rest of details we do have, I said that inquiry is the weakest form of evidence, audit evidence that we obtained, because we are not performing any recalculation, we are not performing any observation, we are not obtaining external evidence as part of our working papers. It's just an inquiry from the management people that how you're going and performing a certain task. So the inquiry is that ascertain if control is operating effectively by conducting an interview with the executor. So you will have a very minimal chance that the executor himself will tell you that these are the flaws or the errors that he have made during the course of his operational work. So inquiry in itself is a weak audit evidence. If we go to a bit higher in the hierarchy, it's the observation. Is that ascertain if control is operating effectively by watching it being performed by the control executor. This form of technique gives you a moderate audit evidence. Like you are saying that control performer is performing a task and you just go there, review how he's doing it, and then document it up that you have gone to the control executor and he entered the invoices and he performed these 3 steps to make sure that control is posted. So it's a moderate level of audit evidence. The examination, if you see, is ascertain if control is operating effectively by inspecting evidences, files, and documents. Like we used to perform the internal control assessment through internal control walkthrough and test of controls. We go to the actual produced evidences or the documents from the transaction. Like if a transaction is posted of a payment for like 100,000 rupees, you will go into the system that who approved the transaction, who reviewed the transaction, who initiated the transactions, who approved the payment, where was the invoice posted, is the invoice amount matched with the amount dispersed, is the tax being deducted appropriately, is the invoice was backed by a PO, the purchase order, if the PO was properly and duly approved. So these are all sort of examination that you can perform for operating effectiveness of a control by inspecting the evidences. These are the 5 documents produced during the process. And examination is, of course, a very solid, a strong audit evidence source. And then we have the topmost strong audit evidence technique is the reperformance. Is to reascertain if control is operating effectively by reperforming it. Like you take a, you can say, a test login in the system, and then execute all the steps that are required to post a transaction, and to from initiation till termination, from posting. So you will go there how a purchase order is being entered, is being evaluated, is being approved, is it approved, how it's delivered to the customer, how the acceptance is provided for the work for the customer, and after that, how is the reperformance being done. So the reperformance gives a very strong audit evidence of how the working being done. So if you look at the left-hand side, you will find out the level of comfort that is provided by the every single technique. Like the inquiry is a weak audit evidence, a less level of comfort is provided. If you go into the hierarchy, it's the observation. Again, the level of comfort is a bit on the higher side. After the observation is the examination. It gives a more high level of comfort. And after the examination, it's the re-performance, and it gives you a much more reliable audit evidence for internal controls. So usually, if you look at the things that we have recently discussed, you can apply these techniques, these 4 techniques, both for manual and automated IT-based controls. That you can go to the system to have a test login. You can perform, if a manual process, you can perform manually all the steps that are performed for a thing. So, as I discussed, inquiry and observation alone, in or in conjunction with each other, do not provide sufficient audit evidence. You would have heard this word very quite often, that this evidence provides a sufficient and appropriate audit evidence. So inquiry and observation do not provide sufficient audit evidence on operating effectiveness of internal controls over the financial reporting, and must be complemented by evidence gathered from re-performance or examination tests. This is because the testing process must be capable of being audited, and therefore requires a high standard of physical evidence. So, inquiry observation do not provide sufficient audit evidence. On the other hand, re-performance and examination are the only 2 techniques that will provide sufficient and appropriate audit evidence for exceptional controls, as they provide an adequate audit trail. So it's very important that, because every single step is documented and you have a proper trail of every step being performed, like who was the person, what was the date, who signed it up. So, however, inquiry and observation are techniques that are often used in conjunction with one of the 2 techniques. Like if you're putting in an inquiry for a control, you can always perform some examination. If you are into observation of how the control is being operated, you can re-perform it on your behalf to make sure that you have a strong and reliable audit evidence, and you have captured all the details that are associated with the technique. So, the bottom line, inquiry and observation will not provide you with all the details and strong audit evidence, but if it is performed in conjunction with the examination or re-performance, will provide you with a very strong audit evidence. Now, keeping this slide in view, the internal control assessment process starts with the system understanding. At the very first step, like we discussed, that while assessing the inherent risk, you understand the business itself, the business model, and the processes, and the nature of transactions that are being executed. So the first step will be to understand the system and the process. The second step will be to perform a walkthrough. You can perform a walkthrough by selecting one transaction, that whatever is being documented as a process or a control, whether it's being implemented or not. If you are fine that the control is designed appropriately and there is proper segregation of duties and there is no exception to the rule, then you can go forward with the test of controls. Then from a population, you can select a maximum of 25 sample to make sure to see whether all the transactions are in line with the documented control, and then you will issue the whether control is being performed effectively or there is some ineffectiveness and needs to be remediation on part of the client. Let's now look at the next slide. This is a slide that will sum up the end-to-end internal control testing cycle for you guys as a step of mind map that you require for yourself. The prime objective of internal control framework is for the management to make sure that their reporting system provides accurate, timely, and transparent information to the management. It means that their internal control policies and procedures are designed properly and documented. Design means that every transaction that is supposed to be performed is performed at a different level, is being reviewed at a different level, is being authorized at a different level. Like say, for example, there is proper segregation of duties. There are proper manual or system-based controls for everything. So it means that the control process for a specific account balance or class of transactions is properly designed, and not only designed, it's very clearly and comprehensively documented to make sure that it provides a narrative details about all the steps that are required to be performed for a certain transactions. The second indicator for a effective internal control system is to that provide guidance to all the staff members or all the employees to execute them, all the steps that are designed and documented. The third step is self-assessment by the management about the effectiveness of the internal control framework. It can happen that the management have defined and designed control to an optimal best level, but for either the reason due to the pressure by the management or the tone at the top, and the management is reluctant to perform the control, these are not being effectively implemented in their true sense, letter and spirit in the environment. And last but not the least, the implemented internal controls that are executed by all the staff members, that are assessed by the management itself as a management self-assessment process, are being audited independently by the auditors, with reliance on working independent testers in some entities. What does it mean? For some entities, the management themselves have a proper department to perform the management self-assessment of their internal control framework or the internal control environment to make sure that they have all the controls properly documented and are being implemented and tested by different management levels. So they need to be assessed independently by the auditors with reliance on the work of independent testers in some entities. So if an auditor comes in and they find their management to be have an ethical environment or and have a high level of integrity and are very rigid about implementation of internal controls, so they can in some ways, in some cases, and up to a certain level, can rely on the work performed by the management testers or the management self-assessors. So what it entails is that internal control framework entails design a testing strategy in place for financial reporting controls. So of course, whatever controls the management has adopted or implemented in their environment, that needs to be tested in some way to make sure the management and the auditor have an opinion about the effectiveness of their internal control framework or the internal control processes. Generally speaking, there are three phases of this assignment. The first one is the design phase, like how the internal controls are designed, whether the design is effective, or the management has taken into consideration all the factors that are key for the effectiveness of the design of a control. The second stage is being tested. Testing means that whether the internal controls are tested by the management themselves, or they are being tested as part of the audit engagement by the auditor. And the last step is evaluation and sign-off. Of course, based on the testing and the evidence gathered by the auditor, they will issue a report at the end of the engagement that these are all the controls that are being evaluated, and these are the deficient, these are the effective, or there are no remediation required from the management. So all these three main stages are then further subdivided. Like for example, if we take an example for the design phase, there are 4 substages. The first one is stage A, determine internal control testing scope. An auditor need to design the assignment to make sure that they cover all the key controls for the testing scope. What are the key controls? Like, for example, an entity have an internal control framework that says that they have 400 controls on different account balances and class of transactions. Out of these 400 controls, the auditor assess that this is the maturity level based on the qualitative and quantitative factors. Like 20 of the account balance and the class of transactions are material and needs to be tested. So all the controls out of the 400 controls that are associated with the material account balances or class of transactions will be tested by the auditor as part of the testing methodology. So these controls that are directly relevant to the main controls are called the key controls, and all the key controls needs to be tested by the auditors to make sure that they have a reliance on the financial reporting cycle for all these material account balances or class of transactions. B is review documented redesign processes. During the testing design phase, the auditor should ask or inquire the management that what are the processes that are changed from the previous years. what is the design changes for those processes, and why was there a requirement to redesign the process, whether it was a malfunction, whether there were some errors or frauds, or is the product line being obsolete, or you have replaced it with a new or more refined ERP systems. So there can be a number of reasons for redesigning the process. And the C is document risk and mitigating controls. They need to document the risk, what are the control risks associated with every control, and then the mitigating controls, that in case there is a control failure, what are the mitigating controls and how they're going to cover it up. For making their a thorough understanding of the control being documented, designed, and implemented, auditor will have to perform a walkthrough to test if process is working effectively. This will help them in two ways. This will help them to capture design deficiencies, that whether the design of the control is appropriate or not. Or second, at this same point of time, they will be able to suggest a proper solution to the design deficiency. If you move from phase 1 to phase 2 is the testing. There are sub two stages. Either the testing can be performed by the management themselves, in case there is a management self-assessment of controls by themselves, or evaluate the estimate impact of definite control on the financial statements. The auditor will themselves test the controls and will evaluate the impact of the definite controls on the financial statement, like on what percentages the control risk is, and what are the definite controls, and how many populations are now being affected by the malfunction of the control, either because of the design or the implementation. Control can malfunction or become ineffective because of either because of the design, like at the initial stage, it was not designed properly, it was not covering all the risk aspects, or it was designed properly, but it was not implemented in proper sense. So both of these things will have an impact on the financial statement for that specific account balance or clause of transactions. And on the last stage of the evaluation and the sign-off, the auditor will develop or disclose required or annual report or sign-off letter of representation or external audit opinion being issued. Like if the nature of the impact deficiency is material and there is a disagreement with the management on the things, and there is a difference in opinion, an auditor can either issue an adverse opinion or issue a qualified opinion, or can you can say issue a modified report in either sense. So these are the three stages: the design stage, the testing stage, and the evaluation stage. How the design is being made, how the testing is being performed, and what are the implications of a control failure for the part of the auditor to make sure that they get the sufficient audit evidence and to form a basis for their audit opinion. So these are the things. It's a slide that almost provide all the details about the testing methodology of the internal control framework that needs to be done. Moving ahead, how will test and sample selection? As there were a lot of questions in the first session, in the first half of the session, about the sample selection methodology, that how samples should be selected. Like a few of our colleagues or our reviewers were saying that usually the test sample selection is being performed by a system, and a system will generate a random sample based on certain statistical methodology. So there are a few tips to make sure that you properly select a sample and that is representative of the total population and not just only a sample of population. So the first point is, and a rule of a thumb for everyone. So for testing purposes, statistical methods are the mandatory options to be used. It always needs to be a methodological way to select a sample. It should be a random sample, there should be a technique attached to it, and there should be not pick and choose that we can select a certain threshold of population and then move forward. The second thing is, the tester would start with a random selection, but consider the following judgmental points. Now here are the points that he needs to consider while selecting a sample to make sure that his sample is representative of the total population and not only a chunk of them. Qualitative and quantitative factors, like applying materiality that we discussed, based on the audit risk assessment, a material level will be defined. Like say, for example, balance of bank accounts, volume of transactions, history of failure for particular control performers. The selection will then be a mix of these factors. Like high volume transactions need to be selected, large balances need to be selected, low volume or small balance accounts need to be excluded, and there should be a partition of it. Like say, for example, there are 10 bank accounts, 2 are being operational, 8 are being non-operational, but you need to send a confirmation for all the bank accounts to confirm their balance. Volume of transactions, like in the 2 accounts that are being operational, one is having a huge volume of transactions and one have a low volume of transactions. But you need to make sure that you select few transactions from the bank with the low number of transactions and the bank account with a more number of transactions for the reconciliation of sort of testing purposes. So it will make sure that based on the qualitative factors, like less transactions, large transactions, or the nature of account, or the qualitative factors like large volume of numbers of transactions or transactions of over a certain threshold needs to be selected. If there are multiple control owners, like transactions are being processed by 3 different individuals in a team, you need to make sure that at least one sample is selected from each control performer. Like there are 3 accountants that are performing executing payments. So in a sample should be representative of all the 3. You need to make sure that every single accountant have a fair chances of representation in the sample. It's not that you select 25 transactions from a single accountant and 2 of the accountant were not selected for any transactions. You need to make sure 8, or 9 transactions should be selected from every, or any of the mix that you can say, any of the mix that you can have. Now, is there interrelated or interconnected controls? When one control follows another one in various stages of process, the tester should ideally choose the same sample. For example, if an analytical review that leads to an adjustment, select that adjustment when the testing journal entry control. It's a very simple thing. Let's take an easy example. If you are validating a payment being made, you need to make sure that the invoice authorization should be tested for the same payments. And if you go down a bit more into the transaction, for the purchase order approval, you need to select the same purchase order that was being approved for the same invoice. So first of all, the purchase order was there and being properly approved. Then for the same purchase order, the invoice was booked and was approved for payment. Then after the due date, the proper payment authorization was made and properly payment was sent to the vendor for the services performed. So it is that if there are interlinked or interrelated controls, so in this example for the payments and the purchase order and invoice, there were 3 controls: the purchase order authorization, invoice entry and authorization, and the payment approval and disbursement. So all the 3 steps in the process needs to be validated in an ideal scenario. And the last one, but not the least one, the tester must ensure all accounts in scope have been tested. All account in scope means all the accounts or the transactions that are material in their sense. For instance, when selecting manual accruals, the tester must ensure that all relevant accounts have been selected, or to ensure the different cost centers are selected instead of a few. Let's take an example of this thing. There are accruals for rentals, there are accruals for salaries, there are accruals for some services, there are accruals for some work that are being executed on part of them. So there are 4 categories for accrual. So for accruals, every single category must be selected to draw a sample to make sure that all the accrual categories are being reviewed and validated. So these are the few tricks and techniques for the tester to make sure that sample is properly selected and their sample is representative of the total population and not a representative of a subpopulation or a stratification. So if you have gone through the testing techniques, so how will you assess that an entity has an effective internal control system? There are certain indicators that are there for every entity that will help you understand about their internal control environment. The first one is tune at the top, that how their management sees the internal control activity. Are they fully aware of their responsibilities? Are they comply with their approvals and their responsibilities that are being assigned to them? And they communicate with each other about the internal control deviations and how they treat the deviations themselves. So the tune at the top is very important at the C level, at the chief level, at the VP's level in different organizations. The board oversight. In certain organizations that are more inclined toward internal control frameworks, they have a proper internal control representative on their board to make sure that board do review the internal control reports and internal control changes and internal control processes. Clear accountability. Does the management have defined clear accountability of every single task? Like for every transaction, have they defined the reviewer, approver, and the recorder or the custodian? And the last one is about the commitment to the values. Then do the management give proper commitment to the value to make sure that employees are abiding by their rules, by the policies and procedures. The second indicator is about the risk assessment, that whether internal controls are properly implemented. Do regular risk identification exercises are conducted by the management? Are control being analyzed and assessed at a frequent intervals? Or risk assessment is embedded in the business processes? Like, are there any reports generated by the management that are on the risk assessment, that whether this area is more risky, this is a new area, this is a new risk, how we're going to address it, how we're going to redesign or reword or re-engineer our business process to make sure that they are up to the mark and with the pace of the business. So are there certain control activities being integral part of their daily operations? Like, is there are controls for every key business process, or their controls being documented, very well defined, and are being tested on a regular basis, or being communicated to the management as well? So the second parameter is that they formalize control environment through policy and procedures. Like, do management have proper portal for policy and procedures? Are all the policy procedures being documented somewhere, are being stored somewhere, and are accessible to the employees for their knowledge and understanding? Are there regular trainings for the new joiners to make sure that they know all the policy and procedures for the department they want to comply with? So these are the control activities that are there. Information and communication. Auditor can ask for the management about the awareness campaigns and regular updates about the internal controls. They want to see that if there is a change in a business process, was the internal process being changed, being aligned with updated for the awareness of the thing? And are there regular update to the information and communication? Is proper orientation and training to the stretch best practices to the team are being provided? Like I explained, that is proper training being provided to the new joiners? Is proper orientation being given to them to make sure that they truly understand in true letter spirit what the control is and how they need to apply it into their daily operations? And lastly, auditor should inquire about the monitoring activities the management have in place about the internal control environment and the control process, like whether there is a periodic evaluation of internal controls, that if there is a malfunction in internal controls or is it a limitation in some of the processes, is management more agile and aligned toward redefining the control or redefining the internal control process, be open about internal control deficiencies, like do they want to speak about the internal control deficiencies that they have highlighted during their internal control assessment. So all these 5 interconnected activities, like the control environment, the risk assessment processes at the entity level, the control activities that are there, the information and communication about the internal control processes, and the monitoring activities that are performed by the management. These are all that adds and contribute to the auditor opinion about the effectiveness of an internal control systems. So as I explained earlier, the internal controls are embedded in everything that organization do. And that's why it is very, very important for the auditor to have a very sound understanding of all the control activities that are performed at the entity level. And it will help them to perform or make an opinion about the internal control environment of the entity. So once we have a look at the internal control environment, the effectiveness of internal control, the internal control characteristics, And then we have a look at the internal controls, testing methodology, that what sort of samples need to be tested. So how an auditor can be successful at the integrated components for the success are. Just to summarize it here for you guys to make sure that you uh, keep them and memorize them, is the champion the audit techniques. There are no rocket science. It is not a very complex process. It's very simple that every individual who wants to be a successful auditor needs to champion the audit techniques. But it means that follow the audit plan and communication by the team management and obtain the necessary trainings. These three will contribute to firm up an auditor understanding of the overall audit procedures, new modifications, new pronouncements, and of course will help them to proper execute the assignment in a more effective and a beneficial way. So what does championing the audit techniques means? The first thing is to take the necessary training. Like if it's starting a new audit or if there is a new pronouncement by the accounting body, he should be part of the training. He should upgrade his skill. He should learn the new tricks. He should learn the new technical issues, that what is happening and how will be working there. For example, these days, there is a new standard, IFRS 15 on the revenue recognition, that have replaced the initial standard for the revenue recognition. So there are a lot of improvement areas still yet. It's a very discussion is going on at the international level as well. So one should be part of the trainings that are provided for the new changes in the international accounting standard, and of course in the auditing techniques and auditing standards. He should be part of the forums from where he can keep himself up to date through either internal communication in the organizations, in their auditing firms or in the department, or from the international communication from their accountants bodies and the you would say the guideline principles from where they are. So he needs to keep himself up to date with all the communications and what are the emerging issues and what are the key focus areas in these emerging dates. And the last but a very powerful point, follow the audit plan. Of course, as we discussed, it's a stepwise process from start, starting from the understanding of the business, then performing the combined risk assessment, then gauging to a materiality level, then gauging from materiality level to the substantive testing, and then from substantive testing to consolidating the evidences and evaluation of evidences, and then to the reporting of the engagement. So these are all methodological steps. So one should be performing and following all the audit steps that were explained to there. After that, there is a part called find and report, is that document the amount of deficiencies identified. As a successful auditor, we need to make sure that we document everything that is there. And that's need to be part of our audit working papers, and all the deficiencies or the deviations that we have found out through the course of the audit or the testing, we need to document all the details. Then we need to recognize the issues and develop and execute action plan for evaluation and reporting. So once we have identified the deficiencies, we should recognize and evaluate the issue. That is the issue pervasive? Is it material? Are there any interlinked or interdependent components? What are the roots for the issue? How it can be remediated, and discussed a proper technique and action plan for evaluation of the issue or deficiencies highlighted, and the proper forum for reporting it out. Like if the magnitude is very huge, is it that the auditor reports need to be modified? Is it that only a management letter need to be issued? Is it that only a board letter to be issued? So we need to make sure that what are the documents that are produced during the audit cycle, and where we can document and capture different deficiencies for the things. And then, of course, follow audit process. And team leads and the management needs to encourage the audit team to adhere to audit policies. Like for every single firm, there is an audit practice. There is a audit softwares, there is a audit procedures, there are certain audit methodology that are there. So one need to encourage the team to adhere to the audit policies and procedures and aim to deliver the step-based methodology for audit execution and testings. And if like an auditor who is there, can champion the audit techniques, know how to find and report the issues, know how to follow the audit steps, and how to consolidate all the audit evidences in their working papers. I'm pretty sure that these guidelines will enable them to lower the overall audit workload and will help to reap the benefit quicker. So these are the interrelated components of the auditor to being successful. So just to make sure that we move to the next session, is that for a successful assignments achievement, the first thing that comes to the mind is the right for the first time. You need to assess your risk on a timely and appropriate basis and correctly. And it will help you reduce the overall effort and will help you achieve the benefits. This is because, say for example, you have set a rating level of 100 million based on a certain assessed level of audit risk. And subsequently, you need to come up with a point that there was some error in assessing control risk, and the maturity needs to be dropped down from 100 million to 80 million. So there will be now a lot of effort will be required to adjust the working papers, resampling, redefining the material accounts, redefining the key controls, redefining the testing techniques. So a lot will be done if there is some change in the assessment at the initial level. So it's all depend that for the first time, be right. Be vigilant what you want to do, be proactive, be knowledgeful for all the things that are required, and deliver the best for the first time. The second thing is find and fix. Do not pile up the things till the end of the engagement. If you have find a deficiencies, find an issue, document it up, recognize, prioritize it, and develop a proper execution plan accordingly. You need to take these issues to your team lead, you need to take those issues to your manager, you need to take those issues to your partners, or any other assignment that you're doing. You need to make sure that you highlight the issues to the appropriate level for the find and fixation at the right time, so that there is no backlog of the issues and there is no, you can say, blockage in the overall audit pipeline. So you need to make sure that you're the first for the first time, and then you need to make sure that you find the issue and fix them at the first instant level available. And of course, you need to champion the techniques, you need to follow trainings, you need to be involved. Need to involve means you need to own the process, own the execution process and testing. There is no limit to your knowledge. You need to keep yourself up to date all the time. You need to make sure that you are in the right direction. You have a very clear objective. So build up every single assignment with a positive mind that you will own the process, you will own the day, you will own the exercise, and just to make sure that you are up to the mark and up to standards that is required from you to deliver. So these are the things about a successful assignment that I require you to be understand and make note of that these will help you out to seamlessly perform an audit engagement and form a proper and vigilant opinion on the financial statements for your understanding. So it covers the second part for the internal control as well. So in case you guys have, I know there will be a lot of questions answered. I was expecting a lot of questions because most of the people will be reviewing the internal control portion for the first time. So in case there are questions, I will be more than happy to help and answer your for this session.
Thank you, Rizwan. There are a few questions. So I'm sure as we start answering questions, people start sending in more questions. So that's, I think, about 4 questions at the moment.
Okay.
Faisal Abdul Qadir is, sorry, let's start with Dilshad Ahmed's question. He's saying, for internal controls in an entry where internal audit is being developed, an explanation will be highly appreciated that the internal audit and quality assurance department is having a clash. Who will be under whose umbrella? Can you please suggest, as per industry norms, will quality assurance be coming under the umbrella of internal audit, or both should be working independently on for internal controls? Please advise.
Okay. It is a very good question and a very vigilant question one. The first of all, internal controls is a separate domain altogether from internal audit. Internal audit is responsible to perform internal control activities. Internal control department or the team is authorized to perform, design the control, implement the control, and test them for their effectiveness. Usually, in the more mature organizations, internal control is a part of finance team, but it's an independent team. Like it's not reporting to the director of finance or budgeting or reporting or accounting. It's a separate team, and it is providing guidance to all the teams to make sure that all the accounting processes are seamlessly working and provide very clear narrative of the process reengineering, redesigning. So it's in way, it's a separate domain. The quality assurance is part of accounting team. It's not even part of the internal control team. Internal control team is responsible to design and implement internal control processes and procedures. The quality assurance in more of the mature organizations is part of the accounting team, accounting and reporting team, that they make sure that accounting information that is being published and being produced is up to the optimal quality and being properly disclosed and accounted for in appropriate way. So if there is a clash between the ownership of the things, accounting quality assurance is responsibility of the finance team. Internal controls is a part of finance team. The internal audit is an independent department that is normally reporting to the CEO or the head of internal audit. So these two are totally different domains. And if there is an issue, internal audit issues will be reported by the internal audit team. However, they can, as part of the assurance team, like there are different assurance teams within an organization. There is internal audit, there is compliance, there is forensic, there is internal control, there is revenue assurance. So there are different assurance teams. Yes, internal control can share their findings, the deficiencies that they have being reported in the different reports to different teams for the corrective actions to be taken. And similarly, the internal audit team can share their findings, the internal control failures, internal control redesigns with the internal audit and rest of the assurance team to make sure that all the assurance teams are working in collaboration and there is no conflict in the organizations. So I hope I clarifies your query. Harun, can you hear me?
Rizwan, can you hear me?
I can hear you now. I just hear you now. I just was listening to you.
Okay, so Faisal Abdul Qadir is saying, what is a risk register? A very basic question, but I'm sure you will be able to help Faisal as well.
Actually, risk register, that is a different thing. It's not part of the today's session we were discussing with the risk from the auditor's perspective. So the risk register that is normally maintained by the management of an entity. Usually in Pakistan as well, now the big organizations or the multinationals, they are having this practice to build up their own risk register. And that department is either called the risk department or the enterprise risk management department. So they maintain a risk register for all the possible categories of risk, like what are the compliance risks that an entity may face. Like say for example, an entity can face non-compliance with the FPR or the income tax ordinance. It can have SECP filing. That is the compliance risk. There can be penalty. It can deviate from the state bank pronouncements for the audit. It's again a compliance risk. What are the regulatory risks? Like if it's being issued a license to operate within Pakistan, if it's a banking organization, there will be a regulatory risk that its non-compliance will result in a revocation for the license. What are the financial risks? What are the non-financial risks? What are the reporting risks? What are the other things? So risk register is a risk documentary that a repository being managed or maintained by the management to make sure that these are all the key risks that are there. For all the risks, they give a proper risk definition. For all the definitions, they give a proper assumption that what is the quantification for the risk. Then they give an impact assessment that what is the likelihood of that risk being materialized. Then they give a management actions to mitigate those risks, and against management actions, they give a, you can say, a scale or something like that, whether management actions are effective or non-effective, need improvement, and then they plot it up onto a heat map, and on quarterly or biannually or annually, there is a presentation for the risk register to the management to see that these were the risks and these were managed in that possible ways. So this register is a document that is maintained by the management itself. I hope it suffices your query for risk register.
Yes, I think quite comprehensively. Hafiz Muhammad Umar Shahzad has just asked a question, says, identify risk, evaluate risk, and mitigate risk. Umar, what do you want? Just explanation of the terms, or you want something else? So, but I think Rizwan, you would have picked up the question.
Yeah, it means that assess risk, the things that are actually, there are different steps in the risk assessment process. Like first at the initial step, you assess a large number of risks. Say, for example, for an accounting process or financial process, you pick up 100 of risks. Then from this risk, you will assess that what are the relevant risks or what are the non-relevant risks. And from these risks, you will see that what are the interconnected risks. So eventually, you will come up a risk that are there for, say, for example, 10 risks out of 100 risks in total. So these are the 10 risks that are the main risk, and then you prioritize them up, that which is the most significant risk, that then the number two, the number three, and then you perform a you can say hierarchy for the risk, that which is the significant and which is the non-significant risk, and then based on the hierarchy that you have prioritized the risk, you provide a response or a remediation plan for that risk. That in case the first action won't work, this will be the second stage for addressing the risk. Then this third stage for addressing the risk, because in case it's an ongoing exercise, you cannot stop if a risk is not being mitigated in a one possible manner. You need to have a plan B or plan C or plan D to make sure that the process is ongoing and it's not abrupted and it's not stopped. So the risk assessment is based on a certain criteria. You then demark the interrelationship, then you prioritize the risk, and then you respond to the risk based on the level of significance that is being assigned to different risks. I hope that this is the question and I answered it.
Yes, again, very comprehensively. Thank you very much, Rizwan. There are many comments that members have made to the session, and Rizwan, just like your last session, members have really liked this session as well. And I'm sure, I mean, we were discussing before the session that probably the session will get a lot, I mean, a bit, I mean, because of the topic audit and internal controls, a little dry. But I think a lot of members have shown interest, and we've maintained about 375 to 400 participants throughout the session. But I think the good thing was that it definitely added value to to the work of members that they're currently doing. I think that's all from our side. You'll be happy that we'll be calling the session out 10 minutes before time. But I think yes, Fawad, thank you very much. Excellent webinar. I would second that. The very comprehensive, and Rizwan has developed this reputation of coming up with very comprehensive preparation for the subject. So thank you very much, Rizwan. Thank you for all the effort that you're putting in, and I'm sure all the members who attended the session will really appreciate your sharing of the knowledge and contribution.
Just to add to that, right now, because internal control is an emerging field within Pakistan as well. So as the time passing on, the organizations are assessing the value of internal controls. So it's a very strong need on part of the members to make sure that they equip themselves with the knowledge of internal controls and to make sure that they do have the skill set to respond to the market requirements for the internal controllers or the compliance managers or the people who are more toward the risk and the risk managers. So this topic is very much interrelated with the new dimension that market is picking up in terms of internal control and risk management. So it was a very good effort from your part to choose and pick this topic and to make sure that the members and the participants are being known to this thing, that these are the emerging fields as well. So I would say that.
I'll just share a few more comments with you, and just because this is your pride in the work that you've done, members are giving some comments. So Adil, for example, Adil Hussain has written that great work, kindly plan something specifically related to internal audit too. Thank you, Adil. We'll definitely keep that in mind. Faisal Abdul Qadir has said that it was a great webinar. Thanks to all those who put effort in presenting it. And that was Rizwan, yourself alone. we didn't play a part in presenting it. So that credit goes to you. Muhammad Ali Arshad is saying, thanks SCCA Pakistan for arranging session on internal controls and audit risk. So yes, thank you very much. Actually, this is an example of the fact that when members come back to us giving feedback, sharing their expectations with us, we definitely this gives us a particular direction, and that's how we can keep coming up with topics that are very relevant to you. And we're now, pouring in comments. All right. So, Rizwan, I will not miss any of those because that's very important. So, Zaman Salim is saying, really very impressive. Need of the hour. Raza Hussain saying, marvelous presenter and organizer. Thank you, Raza. Nabil Ibrahim saying, excellent session. Ishaq Ahmed saying, can we stay connected with Mr. Rizwan in future? Rizwan, you've got a fan following now. So, what do we do?
I will keep meeting the expectation. I will try to keep following them. Yeah.
Okay, so Rizwan, is there a way that you can get in touch with you, your email address, or maybe a WhatsApp group, or what do they do?
Actually, you can always find me up over the LinkedIn, the Facebook. I'm very active on the LinkedIn and Facebook. So
Yeah,
my name is
so
and
Rizwan, I found you on Facebook and I've just sent you a friend's request. So I'd love to be
I'll,
in contact with you.
sure, definitely.
So Irfan Mustafa is saying, thanks for the best webinar. Okay. Mohsen Wazir is saying, excellent session. Usman Khan is saying, detailed, informative, and interesting. Ishtiyaq is saying, I'm an ACCA, CIA, and need to connect with Rizwan Saab from time to time. All right. Akhlaq Ahmed is saying,
Harun, I just lost you.
Rizwan, can you hear me now?
Yeah, I can hear you now. Yes.
Oh, okay. Sorry about these blackouts. We're trying to fix them for some time now. Um, okay, so we're talking about Ishtiyaq Ahmed saying I'm an ACCA and CIA and need to connect with Rizwan from time to time. Ishtiyaq also wants to know by what name does he search you on Facebook?
Yeah, there's one up there. There's one up there.
Rizwan Safdar it is. Muhammad Ali Arshad saying, please arrange session on anti-money laundering. We've already done that, but we are going to have more sessions on it, Ali Arshad. Please note that. Sakib Ali Rashidi is saying, excellent session. Will appreciate if sessions for audit review and reporting will be conducted. All right, noted that down as well. Akib Nawab, thanks, very informative. Furqan Wadaria, whole audit subject is revised in one session. Great. Zumair Manzoor, thanks. Sayyid Amir Shabir Zaidi, very informative and excellent session. Ishtiyaq, thanks once again. So I think a lot of appreciation and praise, Rizwan, particularly for you. Thank you very much for taking time out. And I think it's time for us to end the webinar as well. Any final comments from you, Rizwan, and then we call it off?
Yeah, it was a very excellent effort from ACCA and you as well to arranging this seminar and making it a success. So, and I thank all the participants for the time and effective listening. It was a bit dry topic, but the way they took interest and asked a question, it was very awesome. It was a very good feeling to answer all of them. So thank you,
Yeah.
ACCA, thank you, Harun, thank you all of them.
Yeah, and Rizwan, a final comment. I mean, just for all the webinar attendees, it is actually a challenge to look into the camera. Imagine there are 500 people sitting in place of that camera and continue to talk to the camera. It's a very, very big challenge. And while I was getting a couple of messages from some participants, I am a bit tired now. I mean, you should have looked at Rizwan's the way he was going. I mean, excellent, Zabardast. So thank you very much, ladies and gentlemen, and I am sure you'll stay connected with us in the future webinars as well. Thanks a lot. Thanks a lot. Thank you very much. Okay, Khuda Hafiz, and have a nice weekend for those who are enjoying weekend tomorrow.
Thank you. Bye.